Hey guys, Domenic Neshi here. Today we are with the lovely Eliza Owens. She is one of the chief economists over at Corelogic. I listen to a lot of her commentary, her feedback, and it's great to have her on the show today. Thank you for joining us, Eliza.
Thank you so much for having me. It's a pleasure to be here.
No, absolutely. We're in some crazy, unprecedented times at the moment. I just read your last report yourself and Tim put out yesterday, and the title was basically the fastest growth month on month in the past 17 years. Are we in a boom?
Yeah, I'd say so. We saw that the Australian housing market actually reached a record high value in January of this year. And then over February, values increased a further 2.1%. And what's really interesting about the momentum in the market at the moment is that it's not just happening in one or two big cities. It's something we're seeing across every capital city market and every rest of state market as well. So a lot of submarkets across regional Australia have all seen increases. Many of them have seen increases off the back of the cash rate cuts that were introduced through the COVID-19 period. So this is effectively a response to record low mortgage rates, as well as a swift economic recovery and pretty low levels of stock on the market.
Well, you've just answered three of my questions all in one hit. So thank you for being so thorough. Because what I was going to ask is, where are we seeing that growth in Australia? And largely what I've noticed in your reporting is it is nationwide, that regional centres are growing faster than cities. And I was going to ask, what do you think is driving a lot of this growth? Obviously, the government is putting a hell of a lot of money into the economy, and there's also some record low interest rates. But what else is stimulating this huge recovery?
Yeah, so in terms of the regions that we saw really strong increases across in 2020 and through to 2021, it's been interesting that this record low mortgage rate setting has coincided with a rebound in private mining investment. So as well as Sydney and Melbourne now coming into this recovery trend out of COVID, you've got Darwin seeing growth of almost 14% in the year. Perth dwelling values have risen in value and are starting to see a bit of a defined upswing as well. What we saw over 2020 was that it was really regional Australia, as you say, that kind of dominated, and that's reflected in the annual growth rates where we've got regional Australia up over 9% in the year, compared to a relatively subdued growth rate across the capital city markets. And that has, I think, started to change a little in the start of 2021. So we saw the monthly growth rate across the capital cities and the combined regional market narrow. So regional Australia is up 2.1% over the month, but the capital cities are starting to accelerate and up 2% over the month. We've also seen that Sydney's really reclaimed this position as the fastest mover at this point in the upswing, where Sydney dwelling values were up 2.5% in the month. The Sydney house market is now at a record high value. So typical house value across Sydney is now sitting at about $1,060,000 for the median.
Wow.
And and unit values are probably about 4% below their record high, which was in 2017. But I think, through this year, we could see Sydney as a whole, the whole dwelling market, reach a new record high based on what we've seen recently.
That's a really interesting thing. Sorry to cut you off there, but the fact that we're now surpassing the last high, the last boom in the market.
Yeah. I know, and it's all come off the back of a global pandemic. So as you say, it's record low mortgage rates. There's government stimulus. The government stimulus has largely been concentrated in new homes. So I would not have expected that to have much of an impact on the established dwelling market, with the exception of the first home loan deposit scheme, where there are places for new homes, but there are some places still available for people looking to buy established property. So a lot happening in the construction sector, and I think low mortgage rates and just consumer confidence. We've seen a really swift recovery in labor market conditions where the number of people employed is sitting about 0.5% below pre-COVID levels. And I don't think a lot of people were expecting that. I wasn't really expecting that. So that's created a lot of consumer confidence off the back of those economic figures. This week we have GDP numbers out as well, which might boost confidence further, given we're expected to see a continuation of the rebound.
It's interesting because you are talking about economic indicators, and what I've noticed, we've beaten all of our own projections. And I feel like that's further added to the confidence into the market where, we've forecast dire conditions, and every time we come out and actually post what's happening, it's much better than we projected. And I feel like that may have a further sort of push on the market. And can I ask you about supply levels? It looks like they're certainly coming back, but how are they relative to normal, whatever normal is?
So nationally, we've seen for around this time of year or this time last year, the amount of stock sitting on the market available for sale is about 26% lower. And that's come at a time where sales volumes are actually higher than they were this time last year. So at a time where you've got rising buyer demand, there's relatively little supply on the market. And that trend is fairly uniform across most parts of Australia. The exception at this stage would be Melbourne. Melbourne had a lot of pent-up vendor demand coming off the back of strict restrictions in the September quarter. So ever since the December quarter, we've seen a pretty strong resurgence in Melbourne listings. But even then, it's sort of just sitting on par with what we saw this time last year. It's not like there's exceptionally high levels of stock on the Melbourne market relative to the past 5 years. So yeah, generally listings levels are very subdued.
And can I ask you, how have houses fared compared to units? I read something interesting that you put out the other day, how houses represent roughly 70% of all stock being sold in the market. How have the two performed against one another?
So if we look in terms of value, houses have outperformed in recent months. Across the capital cities, house values are up about 4.5% in value compared to about a 1% uplift in units. So units are still a part of this upswing, but their growth is more subdued. The thing about houses and units historically is that houses, believe it or not, have more volatility in their growth rates, which means that when we go through a downswing, houses will cop greater declines. But during the upswing, houses will make greater gains. I think that's to do just with the fact that higher value assets in real estate tend to have more volatility. So that could be why houses typically have that growth pattern over units. What that means and what that means for 2021 is that I would expect houses to outperform units. Houses, funnily enough, did underperform a little during that brief COVID dip. They took more of a decline in value. But houses are already seeing much stronger growth rates than units. I would expect that to continue over 2021. And we see that in long-term annualized growth rates, houses have outperformed units. Across the combined capital cities, the 10-year annualized growth rates across houses has been about 3.7% a year compared to 2.7% in the unit sector. And again, as you mentioned, that article I did on sales volumes, historically, we've seen that houses make up about 70% of the dwellings sold across Australia. In 2020, that was up to almost 75%. And again, that's a reflection of the fact that the market at the moment is comprised much more of owner-occupiers who tend to prefer housing stock, first home buyers who prefer detached dwellings. And also some of the schemes like Home Builder, for example, has really lent itself to the development of new detached property as opposed to these off-the-plan apartment projects, which take a lot longer to kind of get off the ground at times.
Do you anticipate that the housing market seems to have moved a lot faster than units, but do you anticipate units to then catch up over the course of the year?
I think it depends on the market.
Yeah.
So there are a couple of weak spots when it comes to units, and I would anticipate that inner city Melbourne's unit market over the next 12 months is going to be one that has a bit of higher risk associated with it until you get the resurgence of overseas travel again. I think we have to remember that just because something happened in one period of time, it doesn't mean that that won't change. So I think we're going to see a bit of a subdued period in inner city Melbourne units, but then a bit of a correction and then a bit of a, I think actually quite a bit of high demand once overseas travel picks up. And then you've got unit markets in around your more affordable cities like Perth and Darwin and Adelaide, where first home buyers are quite prominent, the market is rising, and they might be looking for a more affordable option. So I think that interest might pivot back to unit stock purely because of that affordability story over the year ahead.
That's interesting. So because of affordability, people will start looking at units and apartments. Do you then anticipate, we have had a good run of owner occupiers, we've had some really good traction in the market, some growth. Do you now anticipate investors to then step into the market and sort of follow that growth pattern and try and, capitalize on that growth?
Yeah. So, that's a really good point. And I think there's still a bit of work to be done in terms of understanding, is investor activity, is it mutually exclusive to owner-occupier activity? Do they go for the same kind of property? In some instances, they might, and I think a savvy investor might go for something that would be appealing to an owner-occupier anyway. But I think we've already seen a return in investors despite continued strength in the owner-occupier market. So that suggests to me that they're not necessarily mutually exclusive. Investor financing data from the ABS suggests that they've actually been coming back since a low in May last year. Over the December quarter, lending to investors increased about 14% across Australia, with that growth being led by Hobart. So, I think investors are definitely back. They're probably quite interested in the capital growth that's occurring, as well as some of the increased gross rental yields that we're seeing across Perth and Darwin, where rental growth is around 10% a year, and it's actually outpacing capital growth. So you've got more positive cash flow opportunities emerging. But I guess the other thing to consider, which we have less clarity around, is how much of that investor purchase is, say, holiday homes, where you've got Tasmania is kind of leading the bounce back in investment volumes proportionally at the moment. And I wonder if that's people even just domestically looking to get something that's kind of more of a tree change escape or something like that, where it's not their primary residence and it's counted as an investment purchase.
It's an interesting question. And, we look at some of the population data, people moving out of Sydney, moving out of Melbourne, moving to more affordable areas. Regional centres are growing. And we ask ourselves that question often where, now that you can work from home, should I just move an hour and a half out of Sydney, closer to a beach? It's a bit more affordable. And anecdotally, there is a sense of, tree change, sea change, look for some affordability and live a better quality lifestyle, or at least a cheaper one. Do you anticipate that the market will continue at this same rate for the next sort of 12 or 24 months?
Look, I think the headwinds are sort of reduced relative to tailwinds at the moment. I think that a lot of the banks are forecasting these property price increases of around 10% over 2021. And that's probably not unreasonable, given the trajectory that we've seen at the moment. But I guess anything that's going to slow this growth rate down at the moment would be affordability constraints, potentially. It would be I think a potential tightening up in the lending space. I think the thing we have to keep an eye on is the fact that increasing house prices means rising household debt, and the sustainability of that debt and the prudential nature of lending. It's something that is monitored by institutions. And so we may see like an intervention from APRA, for example, maybe something around debt to income ratios, if they do make any interventions. And the other thing would be increased supply. So more listings coming onto the market as potential vendors see that they might be getting more for their property this year. The only challenge with the listing space at the moment is that, you mentioned that migration data. Part of the reason net migration to the regions is so high right now is because no one's leaving the regions either, as people have continued to come in. So until people have that mobility and that freedom to move around and that intent to list their property in order to move, I think the listing space could remain a little more subdued. But ultimately, it's more constrained lending conditions or higher levels of supply that would lead to a slowdown in growth rates at the moment. And of course, COVID-19 being well contained. I mean, that's got to be the big unknown, right? And the rollout of a vaccine. Any resurgence in COVID cases that lead to strict lockdowns would see a decline in real estate activity, a decline in consumer confidence, and those things have an impact on the market as well.
So all things being equal, it looks like the market's in pretty good shape, but if things grow too fast or too hard, we may see some regulatory action from the institution to slow it down. And then there's also the fear of that black swan event. If something else happens with COVID or something crazy in the market happens.
Yeah, that's a great summary. I think that's exactly it. But yeah, all things being equal, I think it's going to be a pretty good year, especially if you're a seller. It looks like continued growth over 2021.
Eliza, I know that you're very busy, so I want to ask one last question. It's a little bit left of center, but where do you see opportunities in the market? If I'm an investor sitting in, listening to you intently and loving your advice, where would you be looking at to invest, or where do you think there's some good opportunities for an investor?
So I think based on migration data and a few other broader market factors, Southeast Queensland looks very good to me in terms of short-term capital growth opportunity. I think in terms of, a braver, more counter-cyclical, opportunistic move might even be some of those weaker markets like inner city Melbourne, for example. It might be a long time before you can get the kind of rental return that you want based on what's happened with international border restrictions. But, given the continued popularity of our major cities, this is a period of time where you could almost see it as prices are kind of discounted at the moment. Another opportunity, I think, is Tasmania. I have been very bullish about Tasmania for a long time. I think it's a beautiful part of the country. And I think given the normalization of remote work and some of the migration demographic trends we've seen this year, that could be an increasingly popular market, not just in Hobart, where there's already been so much growth, but some of those spillover areas like the East Coast or Launceston, I think are really interesting to look at. But of course, disclaimer, I'm not one qualified to give investment advice, but those are some markets that kind of interest me personally. And of course, it differs a lot depending on your individual circumstances and strategy.
Thank you for that disclaimer. Everyone out there, we're not qualified to give financial advice. These are just some of our opinions based on the data that we've seen and what we like. I'll be sure to check out Tasmania when I'm going to visit there for the winter solstice, and I'll have to check out those markets. Eliza, thank you very much for your time today. It's been lovely having you on the show. We'll have to see you again to check back in and see if some of our predictions have come true, and to see about where the next opportunities are.
Sounds great. Thanks for having me.
Pleasure.